Meet Daniel and Marcus. They're both 28 years old. Both have stable full-time jobs. They both earn $65,000 a year. For years, they've lived below their means, skipped expensive vacations, driven used cars, and saved every extra dollar they could. And over time, they've each managed to save $50,000. For both of them, it's the biggest financial milestone of their lives. Daniel has always believed real estate is the best way to build wealth. He likes the idea of owning something tangible. Marcus sees things differently. He believes the best investment is the one that quietly grows in the background, without demanding his time. So, today, we're not comparing every dollar Daniel and Marcus invest. We're comparing two very different strategies for building wealth. Let's follow their journey over the next 20 years, because the outcome is nothing like most people expect. Let's begin. Daniel decides to use his $50,000 as a down payment on a $250,000 rental property. He's not looking for a mansion or a luxury neighborhood. He wants something practical, a reasonably priced home in an area where people actually need housing. After comparing several properties, studying rents, and looking at the neighborhood, he believes he's found a solid opportunity. He takes out a 30-year mortgage to finance the remaining $200,000. At first, everything seems to line up perfectly. A tenant agrees to pay $1,800 a month. Daniel's mortgage payment is roughly $1,330. On the surface, that leaves him with nearly $470 every month before other expenses. To Daniel, this feels like the beginning of something powerful. Someone else is helping pay down his mortgage, while the property itself could potentially become more valuable over time. He isn't just saving money anymore. He's controlling a $250,000 asset with $50,000 of his own capital. That's the appeal of real estate. Marcus takes a completely different approach. He puts his entire $50,000 into a diversified total stock market index fund. He doesn't borrow money to invest. He doesn't try to identify the next big company. He doesn't watch financial television looking for predictions about what the market will do next. Instead, he sets up an automatic contribution of $200 every month. Then he moves on with his life. And honestly, it doesn't feel very exciting. Marcus doesn't have a property to visit. Nobody sends him a rent payment. There is no set of keys in his pocket. His investment is simply represented by a number on a screen. Some months, that number goes up. Other months, it falls. Sometimes the decline can be uncomfortable. But Marcus has made a decision that will become increasingly important over the next 2 decades. He's not trying to make investing exciting. He's trying to make it consistent. During the first few years, Daniel feels like he's winning. The rent arrives. The mortgage gets paid. The loan balance slowly falls. And because the property is a physical object, he can see exactly what his money bought. Every time he drives past the house, he's reminded that he owns an asset. Marcus doesn't get that same psychological reward. His portfolio might gain several $1,000s in one period and then lose some of it during a market decline. There are no tenants congratulating him. There are no contractors calling him. There isn't even anything interesting to show his friends. From the outside, Daniel appears to be building wealth. Marcus simply appears to be saving. But this is where investing becomes deceptive. What feels impressive and what actually creates wealth aren't always the same thing. 3 years into their journey, Daniel has collected approximately $60,800 in rent if the property stayed occupied at $1,800 per month. His mortgage payments over that period total roughly $47,180. That makes the difference look like almost $17,000. But Daniel quickly learns that the difference between rent and mortgage isn't the same thing as profit. The property has expenses that don't disappear simply because a tenant is paying rent. There are property taxes, insurance, maintenance, and eventually vacancies. Maybe the tenant leaves. Suddenly, Daniel has no rent coming in while the mortgage still needs to be paid. Then the property needs cleaning. Maybe a wall needs repainting. Perhaps an appliance has stopped working. None of these costs alone necessarily destroys the investment. The problem is that they keep appearing. And because Daniel manages the property himself, there is another expense that doesn't always appear in financial calculations. His time. A tenant calls about a plumbing problem late at night. A contractor needs access to the property. A repair has to be scheduled while Daniel is working his regular job. A vacant property needs to be advertised. A new tenant has to be screened. The investment may be generating money, but it's also demanding attention. Marcus has almost none of these problems. His index fund doesn't call him at midnight. It doesn't need a new roof. It doesn't become vacant. It doesn't require him to spend Saturday afternoon meeting a contractor. His biggest challenge is psychological. When the market falls, he has to resist the temptation to panic. And that can be harder than it sounds. Imagine Marcus opens his investment account one morning and discovers that his $70,000 portfolio has dropped to $58,000. Nothing about the companies inside the fund has suddenly become worthless. But emotionally, the loss feels real. This is one of the hidden costs of stock investing. You don't have to repair anything, but you do have to tolerate uncertainty. Daniel's investment has its own form of uncertainty. His entire $250,000 asset is concentrated in one property and one local market. If the neighborhood struggles, property values can suffer. If a major repair arrives at the wrong time, his cash flow can disappear. If interest rates rise before he needs to refinance, financing can become more expensive. Neither investor has eliminated risk. They've simply chosen different kinds of risk. By year 5, Daniel has become much more experienced. The excitement of owning his first rental property has disappeared. Now he understands what being a landlord actually means. The property has gone through multiple tenants. There have been repairs. There have been periods when the house wasn't producing rent. Property taxes and insurance have increased. The good news is that rent has also risen. Instead of collecting $1,800 a month, Daniel might now be receiving close to $1,950. But higher rent doesn't automatically mean dramatically higher profits. Many of the property's costs have increased too. This is why experienced real estate investors don't look at rent and mortgage payments alone. They calculate the entire operation. They consider vacancy, maintenance, taxes, insurance, capital expenditures, financing costs, and, if someone else manages the property, management fees. A property manager might charge a percentage of the rent simply to handle the day-to-day responsibilities. Daniel chooses to continue managing it himself because he wants to keep those costs under control. But he is effectively paying with his time instead. Marcus continues doing something much less exciting. Every month, he invests another $200. He doesn't change his strategy because of headlines. He doesn't sell because someone predicts a crash. He doesn't suddenly move everything into whatever investment is popular that year. He keeps buying. And this is where time begins to become more important than almost anything else. At the beginning, Marcus's investment growth is relatively modest. When you have $50,000 invested, even a strong percentage return doesn't necessarily feel life-changing. But eventually, the portfolio becomes large enough that the investment returns themselves begin contributing significant amounts. Suppose Marcus reaches $100,000. A 10% return would represent $10,000 in growth in a year. That's equivalent to 50 months of his $200 monthly contributions. The math begins changing. His contributions are still important, but the money already invested is becoming increasingly powerful. This is the basic engine of compound growth. Your money earns returns. Those returns remain invested. Then those returns can generate additional returns. Over long periods, the process can accelerate dramatically. Daniel experiences a different kind of compounding. His mortgage balance gradually declines. Meanwhile, if the property appreciates, his equity can increase. Suppose the $250,000 property eventually becomes worth $280,000. Daniel doesn't need to have personally saved another $30,000 for that increase in value to affect his net worth. The asset itself has become more valuable. And because he purchased it with borrowed money, the appreciation is being measured against his original equity. This is the powerful side of leverage. It's also why real estate can create substantial wealth when everything goes well. But leverage doesn't make the investment safer. It makes the results more sensitive. If the property rises, Daniel can benefit significantly. If it falls, the debt doesn't fall with it. That's the trade-off. By the end of the first decade, the difference between their strategies becomes much clearer. Daniel may now own a property worth substantially more than the $250,000 he originally paid. His mortgage balance has fallen. His equity has grown. He's also collected years of rental income. But he has spent years dealing with expenses, maintenance, tenants, and the responsibilities that come with ownership. Marcus has spent almost no time managing his portfolio. His main contribution has been discipline. He kept investing through good markets and bad ones. And by this point, something important has happened. The portfolio that once seemed boring has become large enough for compounding to become visible. Neither investor has taken an easy path. Daniel has used leverage and an income-producing asset. Marcus has used diversification, automation, and time. And at this stage, the most important lesson is becoming clear. You cannot judge an investment simply by looking at its most attractive feature. With real estate, it's easy to focus on leverage and rental income while ignoring maintenance, vacancies, taxes, debt, and time. With stocks, it's easy to focus on long-term returns while ignoring volatility and the emotional discipline required to stay invested. The headline number never tells the entire story, and their journey isn't over. The next 10 years are where the effects of appreciation, debt reduction, contributions, and compound growth begin to separate the two strategies in ways neither Daniel nor Marcus could have fully predicted at age 28. 10 more years pass. Daniel is now 48. The rental property he bought at 28 has become a completely different financial asset. If the local housing market has performed well, the original $250,000 property could now be worth somewhere around $500,000. His mortgage balance has also fallen significantly. That means Daniel may have built hundreds of thousands of dollars in home equity without personally contributing that entire amount. This is where real estate can become extremely powerful. He started with $50,000, but over 2 decades, the combination of appreciation, mortgage reduction, and rental income has transformed his financial position. But there's an important detail. The property didn't become valuable simply because Daniel owned it. He also had to carry the costs of ownership for 20 years. There were repairs. There were vacancies. There were taxes and insurance. There were periods when expenses were higher than expected. And there were countless hours spent dealing with the property. His overall result depends heavily on the market he bought in, how much the property appreciated, how effectively he managed it, and how much he actually kept after expenses. Marcus reaches 48 with a very different story. He never owned a rental property. Marcus reached 48 years with different story. He simply kept his original $50,000 invested and continued adding $200 every month. Assuming a long-term average annual return around 10%, his portfolio could grow to roughly $518,000 over 20 years. Of course, actual market returns won't arrive in a perfectly predictable 10% pattern. Some years will be excellent. Others can be painful. But that's precisely why the length of the investment period matters. Marcus isn't relying on one perfect year. He's relying on decades. And there's another advantage to his strategy. His money is spread across thousands of businesses instead of being tied to one property. If one company struggles, it represents only a small portion of the portfolio. If one neighborhood declines, it doesn't determine the value of everything he owns. That diversification reduces the impact of any single problem. But Marcus hasn't discovered a risk-free investment. Stocks can fall dramatically. A major market
And when
crash
your portfolio
can erase
falls
years of gains
30%
on paper in a matter of months. Staying invested requires discipline. Daniel faces a different psychological challenge. When the property market falls, he may not see the decline every day. There isn't a constantly updated price flashing on his phone. That can make real estate feel more stable than it actually is. But an asset doesn't become less risky simply because its price isn't updated every second. So after 20 years, who wins? The answer isn't as simple as choosing real estate or stocks. Daniel used leverage, rental income, and property appreciation to build wealth. Marcus used diversification, consistent contributions, and compound growth. Depending on the assumptions, either strategy could come out ahead. A strong real estate market could make Daniel the winner. A stronger stock market could put Marcus ahead. And a poorly chosen property could make Daniel's 20-year journey far less rewarding. That's the bigger lesson. Investing isn't about finding an asset that magically makes you wealthy. It's about understanding what you're buying, what you're risking, what you're paying, and what you're giving up in exchange for the potential return. Real estate can provide leverage and recurring income, but it requires capital, management, and tolerance for concentrated risk. Stocks can provide diversification, liquidity, and powerful long-term compounding, but they demand patience through market volatility. Neither investment is automatically superior. The best strategy is often the one you can understand, afford, and stick with for decades. Because in the end, wealth isn't usually built by choosing the most exciting investment. It's built by making reasonable decisions repeatedly, avoiding catastrophic mistakes, and giving your money enough time to grow. Daniel and Marcus started with the same $50,000. 20 years later, they may have reached surprisingly similar destinations. But they got there by paying 2 completely different prices. Daniel paid with leverage, responsibility, and time. Marcus paid with patience, discipline, and the emotional discomfort of watching the market move against him. And that may be the most important investment lesson of all. Don't ask which asset always wins. Ask which strategy fits your financial life well enough that you can keep following it for the next 20 years.